What we'll be covering is what's the classification of joint arrangements, the accounting treatment. It links into, again, the continuous assessment kind of element, the disposal, as well as the disclosure and examples. The disclosure, all of that would again be consistent with 112. So we'll come to that as the next session after this one. So in terms of the scope of the standard, it's applicable to and applied to all entities that are party to a joint arrangement. And what joint arrangement is, we'll just kind of come to that in here. That's the definition for joint arrangement. It's an arrangement over which two or more parties have joint control. It could be either a joint operation or a joint venture, and you've got various characteristics to that. One is our party is bound by contractual arrangement. Two, our contractual arrangements gives more, two or more of these parties joint control of the entire arrangement or not. That control arrangement is defined, is not always, doesn't have to be in writing per se. It could also be kind of, the way they operate, the activities are actually operating per se. The control and this is kind of linking back to Ind AS 110, where it's talked about the control. Does the investor have kind of exposure changing? Can he really change the returns or not? What power do they have? Relevant activities. I'm just going to skip this one if people have questions. This is a repetition of the one, but if people have questions, feel free to stop me. I think this is something that will just demonstrate the example in terms of what's really a joint control or not. So let's consider example 1. So the requirement is 75% vote is required to direct the relevant activities of that entity. Party A has got 50%, B 30%, C 20%. So what do people feel just based on those limited facts? In which of those examples will there be joint control or no joint control or not conclusive? So you've got example 1, party A has 50%, party B has 30%, party C has 20%. So would party A be able to make a decision on its own, because if it requires 75%, it will not be able to make a decision, right? The same in example 2, if you've got a 50%, 25% and 25%, could again party A, so in any of those examples, party A alone cannot make any decisions because not reaching the 75% threshold. In example 1, it could if B was to support A, right? In example 2, it's not really conclusive per se because you don't really know which party is going to support, with two parties having 25% each. In C, it's really widely dispersed, right? So I think here what we're saying is, even though A cannot block any decision, it does not control because it needs B to agree to any decision to be made. Similarly, in B, you've got no control because you've got multiple combinations possible. We don't know which entity will support, be that B or C. Here again, we got multiple combinations.
But in the first two cases, why can't we say that they have joint control like A, B, C?
So I think let's cover both of those examples. In example 1, A cannot alone make a decision, right? So it will have to be supported by B to make any decision. So therefore, we're saying it's got joint control between A and B.
So there is joint control.
Yeah, there is joint control. Okay. But A alone cannot make any activities. There's more indication that it needs B. If B agrees, then there's joint control.
Yeah, if A alone can do it, then it's a kind of a holding.
Exactly. Whereas in example 2, you could have any combination. A could either get B's support or C's support. Yeah.
So in the given example 2, like, can there be more than two joint controllers? Yes. In that scenario, the party ABC, all three will become joint controllers.
But you require 75%, right? Now, if A is there, you'll always have A to be present, right? If B is supporting A, then you have A and B reaching that 75%. If C also supports, then you've got a different element. But we're taking either or. If you could have any combination that's taking place.
In this simplistic scenario, it's only sticking to this fact pattern which is really there, this combination. So that in this example, it is said that because either of them, A and B can trip C, or A and C can trip B. Therefore, it is all three on them are not joint control. That's how it is. But if you have a contractual arrangement where we say all three has to say yes, then the life becomes different. Okay, then the assessment will be different.
In example 3, since there is a majority vote, so can we say it is a joint control? Since if A and
So I think majority we're saying is at least 75% here, whereas A and B will only be 70%.
No, majority 51. No, they are not mentioned.
They've not mentioned that. So what they're saying is 75%. They've not really said what is majority per se. Yeah.
Even in this particular scenario, if you look at 35 and there is a widely dispersed, which is really there. So there are multiple combinations which is possible. So everyone comes and votes, which is really there. Then they can even go out and another 30% can go out, it becomes 65. So A along with other people, it is possible in that sense, theoretically. So even B along with other widely dispersed group, theoretically can trip A. So therefore it is not, it is similar to example 2 in that. That's how.
I think what we kind of coming into the classification of joint arrangements. I just want to talk people through this core concept here, and then we'll kind of go into other examples. So if you've got a legal form or not for a separate vehicle, now that legal form, do you really have access to the specific assets or not? If you don't really have access to specific assets, then most likely it will be a joint operation per se. But if you've got assets specific, then it'll kind of go into a joint venture kind of element. So if you've got contractual terms on that, I think just to kind of clarify what we're trying to say on the yes and no, if people find it simpler to look at the table per se, those two slides are doing the same thing. If you've got that specific asset thing, because it's being defined, you could say you've got a legal entity, through that you've got a joint venture, and therefore it's indicating that kind of control in terms of the joint arrangement per se. Whereas if you don't really have any legal defined boundary per se, it's more indicative for joint arrangement.
So I think in a simplistically speaking, in a joint venture and a joint arrangement, okay, joint operation, there are only two classes.
Yeah.
If we say under currently Indian GAAP, we have how many joint, if you see joint venture, we have three classes: jointly controlled asset, jointly controlled operations, jointly controlled
entity. Yeah.
Now we have two classes only. If we have joint ventures and joint operations, right? Now the difference, what is the difference between joint venture and a joint operation? Joint operation. In a joint operation, there is a joint control, but they say each one has a right to individual assets and liabilities, and not on the net worth, on the residual interest of that entity. So, for example, if let's say there is a company which is really have 4 real estate projects, okay. Now, and it is a joint control. But we say that the output, the benefit which I will get, I will want joint control only over project A and project B. So I will have access to only project A and project B. Project C and project D is done by someone else. Okay, but that is the other guy's thing. So when you are sharing individual assets and liabilities, when you have control over specific assets and liabilities and not on the net worth, which is really there, then it is a joint operation, because you are having a separate thing which is there, where you have rights to the individual assets and liabilities rather than net assets of the company. But if you have an arrangement where you have access only to the net assets of the company, which typically any shareholder holding company shares,
got legal form.
They will access to only net assets of the company, the net worth of the company, then it will be a joint venture. So now having look at that, look at this particular example. So if it's a joint operation, normally, if it's a separate legal vehicle which is really there, and like an incorporated entity, more likely than not, a company will ideally become a joint venture, because all of us know when we buy shares, we are exposed to the net worth of the company. We cannot claim individual rights and over the assets of the company, right? So I cannot say company में अगर building है तो इसमें 25% building मेरा है, right? It's not, doesn't work in that fashion. Whereas if you vis-a-vis an oil and gas unincorporated JV which is really there, I can say 25% of the output is mine, right? In that case, that is a joint operation, oil and gas, unincorporated JV. Whereas company example which I gave, it is a joint venture. Okay, so normally without a separate vehicle or a separate vehicle, that's how it will really work.
So if two parties are exploiting a product, or it's an IP product, having a joint ownership like 50-50, and both are earning the revenue like 50-50.
Right. So go back to that flow chart. No?
Yeah.
Now you need to pass this test. Okay, you need to answer this question. So first of all, when you say two IT companies developing a joint product, okay,
is there a legal entity?
It is a joint operation.
Is there a legal entity?
You need to go through this chart. Is this a legal form of a separate vehicle or not? And if it is a legal form, yes, then you say, does that legal form give access to individual assets and liabilities to each individual owner? If answer is yes, then it will be joint operation. If answer is no, then it will be joint venture. If you say no, it is not a legal form, it is an unincorporated venture, association of person or something like that, then you say contractual terms of the arrangement dekho. As per the contractual arrangement, if you are sharing individual assets and liabilities, joint operation. No, joint venture. And then, in both these cases, you need to look at other facts and circumstances as well, and to reach the particular assessment. That's how it will work. Everyone very clear on the classification? So one of the major things on transition which you will have to do is, all your joint arrangement or joint venture classification, you need to bifurcate into what are joint operations and what are joint ventures. Okay, that's the key action point for all of it.
But the joint operation and joint venture can be called as a AOP, as an example.
No, AOP is it's a concept of a tax concept. Okay, when I say association of person, it can be a legal taxable entity. Okay, but there could be a contractual arrangement by which you can really share assets and liabilities. So that has nothing to do. You have to see individual facts and circumstances and the way your contractual things, legal rights and obligation, and decide classification of any entity or anything which you call joint operation, joint arrangement. Based on that, you will decide this classification. That's how it will work.
I think, just simplistically speaking, if you think about, Indian GAAP, you've got 3 classifications. Where it's really coming into Ind AS 101, you've got basically the joint arrangement. If we kind of going into the bucket, that joint arrangement could either be joint operation or joint venture. There's nothing else other than that, per se.
But in Indian GAAP, joint operation is not defined, right?
So in Indian GAAP, joint operation per se is not there, but what that is kind of coming into is kind of saying if you've got assets and liabilities, you've got proportionate consolidation or not. So if you've got
in Indian GAAP also, you have not joint operation, you have jointly controlled.
Jointly controlled operation, jointly controlled, and it's the same in substance. So let's just look at this example. So you've got A and B, which jointly establish a new corporation, corporation C, in which each party has 50% kind of interest. The incorporation enables the separation of C from A and B. So it's a standalone, it's a different kind of entity. The assets and liabilities of C are the assets and liabilities of the incorporated entity. And the legal form of the separate vehicle indicates that the parties have rights to the net assets of the arrangement. So in this kind of action, so without stretching our imagination, what do people think? Is it a joint venture or is it kind of more of a joint operation? JV? Do people think it's a JV? Yeah? That's what it is. Yeah?
So is like accounting different for a joint venture and joint operation? Or?
Yes, it is different. So I think it's a very important kind of criteria to bear in mind, what we were saying earlier. So if you've got a joint operation, because you have access or control to the individual assets and liabilities, you'll take in those individual assets and liabilities into account and say, okay, how am I going to accounting for that? Which is similar to proportionate consolidation, but not the same as proportionate consolidation. Whereas if you've got a joint venture, that will always be generally equity accounted. So it will be a single line item. So even if you've got currently something that is classified as a joint venture under Indian GAAP, if it's not a joint venture, if it does not meet all the requirement, it could, there's a possibility it could swip into a joint operation and vice versa as well. So it's just important to reassess that whether it's a joint venture or if it's a joint operation, because the accounting will differ.
But for IGAP, we use proportionate consolidation.
Yeah, and proportionate consolidation is not allowed.
Okay, but for IGAP, I guess we use that.
So for IGAP, we use that, but that is no longer permissible under Ind AS. And there's a difference between, so there's an example, I think I'll just come to that slide if people prefer that whilst we're on the topic. 31. I'm just flipping quite a few slides just to demonstrate the point we're talking about. If I go to page 31. Yeah. I'm just trying to show the example, what we were trying to say in terms of your proportionate concern, what really happens. So this is the fact pattern. You got D and E, which is establishing a new co-F. That legal form of separate vehicle does not confer separation between the parties per se. D and E each own 50% of F. However, as per the contractual terms, so if you think about the three buckets we're talking about, legal form, contractual arrangement, and that. So if the contractual arrangements, D has access to all rights to building 1 and the obligation to pay all the third party debt. D and E have access to all other assets in F. That's the fact pattern in this particular example. Where if you were to look at F's balance sheet, we've got debt of 120, employee obligation of 50, equity of 70. Similarly, cash 20, 120 building, and building 2 of 100. Now we know from the facts and circumstances that D has the obligation to pay all of the debt and it controls building 1. Right? So the balance sheet of B, if you were to look at it, and this is likely to differ from a proportionate consolidation, just to illustrate that, the balance sheet of D would look like you've got cash, which is 50% of 20, of 10, building 1, the entire 120, and building 2, 50. So that is not the same as what you'll have previously. So that's just something to kind of demonstrate of how that really matters. So this is just kind of going into, so we just moved ahead, we're coming back to where we were whilst the question was asked. So in terms of classification of joint arrangement, we've got facts and circumstances which indicate whether a joint operation results in parties having rights to the assets and the obligation for the liabilities or not. This may happen if you've got restrictions on customers, expectations to fund losses or not. If you've got, when we're doing Ind AS 1110, there was criteria about the purpose and design of the particular arrangement. Many a times what will happen is, even though you've got investors coming on board, they may or may not want to consolidate, or even for that matter, show it as a joint venture. What do the analysts feel in terms of whether something is entered in a joint venture or not? Because sometimes analysts just give a discount to joint ventures. So I think those sort of arrangements really drive the commerciality behind the classification of the arrangements as well. Here we got the fact patterns in terms of, if neither has legal form or contractual arrangement. However, if you've got A and B agreeing to purchase all the outputs of C in a ratio of 50 to 50, C cannot sell any of the output to third parties. So it has to sell to A or B either, unless that is approved by A, and B is expected to be uncommon. And the price of which the output is sold at is designed to cover the expenses incurred by C. So what we're trying to say here is you've got a joint operation per se. Because in effect, you've got A and B both agreeing for that. You don't really have a specific form per se. You've got a price which is designed to cover the expenses. It's all really happening as a joint operation. It's not really going with the net assets per se. You got an example of a telecom company. So A and B establish a NewCo. They transfer all your towers in telecom industry. You can transfer all of that to a NewCo. And the A and B have direct rights. The key words here are direct rights to assets and liabilities based on the proportional shareholding. And the NewCo decisions are unanimously made between A and B. So again, it indicates this is a bit of a joint kind of operation because they have direct rights.
When will this become like a joint venture?
So if you have A, you have a separate legal form. B, you don't really have access to the individual assets and liabilities. If it was to the net assets of the entire operation, then it would become a joint venture.
And if A and B both on individual capacity buys the equipment and lends to the new company, then it's not.
Well, if you've got a lending happening, but then ultimately if you've got a NewCo, the assets are still being purchased by two separate entities. Now, if it's been lent to a new entity, then ultimately you have to look at the decision what's happening between A and B. Who's got the risk and rewards of that ownership per se?
That is not a joint venture.
So that does not necessarily have to be a joint venture. You could have, what will happen many a times is, say for example in the pharmaceutical sector, right? One company might say I want to develop a drug. I've got a certain patent and technology. Another company's got another patent and technology. They might combine both the businesses together. And that might be creating a separate joint venture per se as a legal entity, that what is the rights and obligations or what is the contribution of each party to that new arrangement per se. If in that new arrangement we're saying specifically whatever profit that new venture is going to create, then that share is being distributed back to A and B as the new, then that's more of a joint venture per se. Whereas if you have specific assets liability, okay, this operation is going to generate 2 drugs. One drug is going to go to one entity, the other is going to go to another entity. So in that case, it's more of a joint arrangement per se rather than a joint venture, because you've got individual assets and liabilities that you may account for.
Operation.
Yeah, joint operation. Yes. Yeah. Just gonna go into here. So just to kind of debrief, so A and B have, if they do not have any direct access to rights in assets and liabilities, the network capacity, if it's only being shared by A and B, and that was the reasoning why we were saying in that telecom example was kind of coming to a joint operations, because you don't really have direct access per se.
But in the first case also it was, they were having direct access.
Yes, so that's the justification. If you got direct access, then it becomes a joint operation. But if you don't have direct access, and if you got access to the assets and liabilities only, then it's a joint operation. But if you have a new venture that's created and it's in the assets, net assets of that company, then the two key words to remember if you think about a joint venture: A, if you got a separate legal form, and B, is it access to the net assets of that company, or do you have access to the individual assets and liabilities? So if you've got individual assets, liabilities, then you'll think joint operation. But if you don't have individual assets and liabilities, then you'll think about a joint venture.
So you're also in an indirect way, if you look at it, what they are saying is just a variation of a joint operation example only. Earlier they have direct access to a specific assets and liabilities. Here in this example, what they have done is that there's a network capacity being created, but the entire output can be taken by A and B only, and they say they have decided, okay, that how it will really work. Okay, that both the financing and everything is driven by them. They are the only people who can take the output of this. So in a way, indirectly, you are taking that individual assets and liabilities network capacity only. And therefore, it is a joint operation, because what they say is that because the liabilities and costs will be settled through purchase of capacity by the operator. So each individual guy ideally is just interested in getting the network capacity. The cost and everything will be borne by them. So they will be running the cost because everything will be financed by them only. So in substance, in this particular case, what they are saying is they will be doing it operating at a break-even level. There will be no profit margins at all in this particular manner. So what both of them have pooled the asset. They have decided that they will take, instead of now, like say I contributed towers, he contributed towers. Total will be 100 towers. At any given point of time, 50 towers I will take, 50 towers you will take. And for all practical purpose, it will be cost to cost kind of an arrangement. Financing is done by both of us equally in that case. So in substance, it is not a net residual interest. It is basically access to individual assets and liabilities, because I am responsible to fund 50%, he is responsible to fund 50%. That is access to individual liabilities, and access to individual capacity is also in that fashion. So that's how it will work. So therefore, this is a variation of the same thing, but in an indirect way, you are saying that this is still a joint operation and not a joint venture, even though you are not identifying a specific asset.
So we just look into the accounting point that we were touching upon. So this is saying under Ind AS 31. So if you got jointly controlled operations, jointly controlled assets, jointly controlled entities. So those are the three kind of elements. We are recognizing as assets and liabilities share of its income and expenses. Similarly, for jointly controlled entities, we are either doing equity accounting in terms of equity method, or we are going a proportionate consolidation. We know proportionate consolidation is no longer permissible under Ind AS. So the question becomes if you've got joint operations or joint ventures. So this slide is really summarizing where the differences was coming from. Previously you got the three classifications. How are you accounting for that? Now you can no longer account from a proportionate consolidation. If you've got a joint operation, i.e. you've got the parties with joint control having the rights to the assets, i.e. direct rights, then you kind of think about the assets and the liabilities. The example we looked at, the 240 with a building example. So that's the kind of example that links it to joint operation. But if you've got a joint venture, then you go into equity method, which is a single line consolidation.
So
yeah?
If you think of a group which is doing proportionate consolidation, what is going to happen? Their entire revenue, top line, the expenses, everything will go up. Even though at a profit level it will remain the same. So there has to be a lot of stakeholders education and analyst education. I was just recently looking at one balance sheet of an auto component company which was really there. And what I really realized, if they take away the JV, almost 3 to 5% of their turnover gets washed off. Now, that's a huge impact. They need to really communicate to their analysts and everyone that, okay, this is just an accounting thing, nothing has undergone a change. And that those kind of stakeholder communication would be very relevant. So, I think this is something which is very important. If the company, if a group has a lot of joint ventures and other things, they really need to assess the impact on the KPIs of what will happen if at all it moves from proportionate consolidation to a single line equity method of accounting, and how the what my results will really look like. Okay, so it's like collapsing of balance sheet certainly will happen, and your assets and liability in your P&L also, it basically will really shave off in that way. The grossing up will really get collapsed again into a single line item.
Because the analyst might be kind of basing the valuation on top line, they might be basing it on PBT. So whatever the various aspects are, if you could just manage the market communication to that angle. What you got here is just into
the current accounting standard 27,
31.
31. This is no.
Yeah, AS 27.
Yeah,
AS 27
allows equity method only, right?
AS 27 does not
Proportionate consolidation.
Yeah.
Proportionate consolidation.
Okay. And here it is written equity or proportionate consolidation. So what does that mean?
So what we're saying is, if you've got
Jointly controlled.
if you've got jointly controlled entities, then you've got equity accounting or proportionate consolidation.
Just to
But
clarify, what happened in IFRS, okay, which is really there, in earlier, before this new standard came into picture, it was both proportionate consolidation and equity method which was allowed for joint ventures accounting. When they moved on to this new standard which was really there, now it's only equity method. So I think here it's of a typo. If at all,
that is a
when
typo.
we look at this ES 27, we should only have a proportionate consolidation here. There is no equity method of accounting. And when we really drill it down here, it will only be an equity method of accounting. So, but when this was more, when we really, a slide which was really there where you can even contextualize when we were the IFRS, erstwhile IS 31 was also there. So that's the thing what we really, it has just come in that fashion. So this slide was more prepared from an IS 31 perspective, earlier which was really there in the IFRS, ISB IFRS thing. It had this three same classification, but it allowed both the methods. Now when they move to Ind AS, which is or IFRS equivalent of IFRS 11, it is allowing only equity method of accounting. So in AS 27, you don't have equity method, you are right. So that from that perspective, there is a type.
So now Ind AS 31 is no longer there. So
yeah,
IS
IS 31. So that's been superseded. Yes. Yeah. Just in terms of joint operations, this is just kind of reiterating the same point in terms of assets and liabilities, and then revenue and expenses. We're taking share of that, so you got proportionate kind of element, but it's not really kind of allowed from that angle. So you kind of say, okay, what are the various line items that you've got assets and liabilities, which we demonstrated through that example that we had. When we accounting, so when is the accounting for a joint operation the same as proportionate consolidation? So, yes, you've got equal rights to assets and liabilities, so it's probably the same. But if you've got rights to a specific percentage of certain assets or not, then that will give a different result. Equally, if you've got the nature of assets and liabilities, that might be changing. So again, thinking back to the example we were looking at, because we had specifically had 100% access to the building, 100% debt, then it's giving a different answer compared to when you were doing proportionate consolidation, because you had a specific requirement here, which was this example we were looking at. So you're saying even though it's similar to proportionate, it's not the same. So joint operations are determining the relevant Ind AS. So if you've got joint operators, they're required to recognize the assets and the obligations in accordance with the relevant Ind AS. What that's trying to say is, if you've got a joint operator, you'll have to really analyze that what's the nature of the assets and liabilities that it's got responsibility for. And if you've got, for example, a joint operator which would recognize the share of an asset in accordance with, for IAS 16 or Ind AS 16 or Ind AS 38, which is intangible assets, then what are the contractual rights and obligations of that particular joint venture or operator? Accordingly, it will kind of not be a share of itself, but the operator will need to determine whether the arrangement contains a lease. Now, just to kind of bring a bit more practical relevance to this. So there were a few questions asked earlier. What if I've got a supplier? The supplier's 100% of the output of the supplier is being purchased by another party. So does that really arrangement mean a lease or not? Now, under Ind AS 17, if you look at the appendix there are a lot of consideration in terms of if the buyer or the party who's being supplied to has the opportunity to buy everything. So there are two criteria there. One is there a right to use a specific asset? So you could have, for example, a factory on all the output from the factory. If it's all just defined to one specific factory, then yes, you got all from the particular factory. Two, all the output that's being generated is being purchased by another entity. Now you could have that even in power plants, for example. You could have a captive, or you could have another power plant solely dedicated. You could have supply chain management. If I've got one assembly line, and that assembly line is only dedicated to supply to one particular customer of mine, then does that really mean that I've leased that line rather than I'm owning that line? So that's the consideration this is bringing from a practical angle. What the standards then goes on to say is, even though that you might be getting all the output from the particular plant, we have to look at the commercial considerations. So if the output is fixed per price per unit, then they may not really be reflective of it being a lease. But if you've got some variability built in, or if it's indicated as non-market terms, then that will indicate it's more likely or not to be a lease. It's a very judgmental area, but it's just kind of saying that all of this needs to be considered, especially if you've got a joint venture and other arrangements or operations for that matter. Because you could have different financing vehicles, you could have all the output being supplied to those partners in that arrangement or not. So who's really controlling that, as well as how is that being accounted for? The accounting for joint venture is the equity method. So it removes the choice offered by kind of Ind AS, I think this is from a 27 angle as well, to either apply proportionate consolidated or equity. So Ind AS requires the equity method in all cases. I think point bullet 2 is the key point there. The application continues to be covered in Ind AS 28. However, there got some exemptions there. One is if you got the entity as a parent that is exempt from preparing consolidated financial statements. So CFS is by the scope of exception in Ind AS 110. Equally, if you've got an investment in an associate or a joint venture that is held by or is held indirectly through a venture capital organization or mutual fund or unit trust, then they may elect to measure those investments in associates. So again, it can't go into other accounting standards. It's not really part of this standard per se. That's the key point. I think you just have to mention it may elect to measure those investments in associates and joint ventures at fair value through P&L. And that's kind of goes into IAS 32 and 39. We'll have a bit more detail in some of the other subsequent classes where we'll look into financial instruments, classifications of the financial instruments, where it's fair value through P&L, loans and receivables, so on and so forth. The disposal of an interest in a joint operation. So if you've got an entity which is disposing its interest in a joint operation, it ceases to account for the rights to those assets and liabilities, and only recognize any gain and losses as the disposal date. And again, I think we just got to again keep in mind about the P&L and the reserves element as to what's really happening. In terms of joint venture, again, if it's disposal interest in joint venture, it ceases to use the equity method as of that date. And it de-recognizes its interest and recognizes any upside gain or loss as a result of that joint venture. The question we were asked earlier here, whether we are required to restate or not. So again, we just kind of clarify. So there's no restatement required because it still was correctly accounted for at that point of time. If subsequently circumstances change, those can be explained through notes as to what the group looked like on a standalone basis versus not. Yeah. So continuous reassessment. So accounting for all those arrangements pre-Ind AS is basically saying it's changed mostly in line with the ownership interest. So if you've got any changes in any contractual arrangements, you just got to always keep an eye on that. Is how the contractual arrangements really changing. Equally, if you've got a revised definition of control. So previously you had the voting rights as well as governing body. Here you don't really have that. So management need to reassess what are the facts and circumstances in this scenario. How is that really changing? How am I accounting for that? If I've got a joint arrangement or not? Is that really the same as joint operation? Is it joint venture? Is there a flip between the two? Are we in the right bucket? How are we accounting for it? Should we, if it's not proportionate, it's not going to be the same. if I've got equity accounting, all of that is going to really impact. Also think about the other wider commercial aspects in terms of communication with analysts and so on. So that will all kind of factor into this account. The key kind of point there is just saying in terms of Ind AS 112, the next session is about the 1112. We'll cover up on time because that's just more of a disclosure angle. So I know people are looking at their watches, so we're conscious of that. Just in terms of the disclosure requirements, it's all really being encompassed into one standard. So 112 will cover in description what the standards are. Now, from a wider Ind AS specific angle, the disclosure requirements are onerous. I mean, just having a look at certain entities, if under Indian GAAP you probably had 60, 70 pages, those same entities, under Ind AS, we can see they're nearly like, from 70, 80, they've gone to 120, 130 pages. So it's nearly doubling in size. So there's a lot of onerous disclosure requirements. And I think here, that's where I think we feel a lot of entities will really struggle. Be that in fair value, be that business combinations, be that arrangements, just generally related party transactions, all of that will really come into picture. This is just an example, which I don't think is that critical. I think we'll just go to the, I'll just cover this very briefly. So this is again linked with that. I think I can see a few nods saying I should move on. But, just in terms of, I'll just kind of point out the uniform accounting policies. That the policies must be uniform to those who venture, unless it was impracticable. But under Ind AS 101, if people are taking that kind of route that is not practicable, that impracticability exception no longer exists. You just got to be kind of conscious of that element. Equally, the reporting date, it cannot exceed 6 months previously, but now it's 3 months. So again, you just got to be careful in terms of year ends. Now, it's a very common, Indian entities will have 31st of March, whereas outside India, I've seen a lot of entities have 31st of December. So then 3 months is okay. But if you've got any other kind of permutation combinations, that you might be kind of captured by that. So just be kind of aware of those angles.